In this video, I'm revealing a simple and profitable trading strategy that is proven to have a high win rate of over 80%. And at the end of the video, I'm going to prove it to you by backtesting this strategy 100 times. This strategy is so simple, it only requires three components: the trend, support and resistance levels, and uses one tool, the MACD. The MACD stands for Moving Average Convergence Divergence. It is a standard indicator most traders are familiar with, but few know how to use effectively. As one of the most popular indicators, it is a momentum oscillator and it takes two moving averages and measures the difference between them. So there are two lines, the MACD line and the signal line. Now, it might look like a lot on the charts, but let's break it down each line really quickly, and you'll see that this stuff is actually pretty simple. The MACD line is plotted by subtracting the longer moving average from the shorter one. It fluctuates above and below zero as the moving average converges, crosses, and diverges from each other. Here's a chart where we've isolated the MACD line below, and on the chart above, we're showing the two moving averages that it's using in its calculations. Now, let's add the signal line back in. The signal line is the moving average of the MACD line. And sometimes there is a histogram, and the histogram measures the distance between the MACD line and the signal line. The fast moving average length is at 12, the slow moving average length is at 26, the signal line length is at 9, and it uses the exponential moving averages. But all these don't matter for now. The MACD does a very good job of detecting momentum, and a common way of using the MACD is by taking a buy position if the MACD line crosses above the signal line, and taking a sell position if the MACD line crosses below the signal line. However, when you look more closely, the MACD has two major shortfalls. Because it works based on the moving average, the MACD tends to signal an entry late, or what we call a lagging signal. And the MACD works best when the market is trending. So if the market is moving in a sideways, the MACD could give false signals. Knowing the shortfalls of the MACD, we have created the TSRI MACD. The TSRI MACD is a mathematical recalculation of the MACD that eliminates the problem of a lagging signal, and it also reduces the false signals in a trending market. Now we'll compare the performance of the two MACDs, highlighting how the TSRI MACD provides an earlier entry signal compared to the normal MACD. Here, a sell signal was indicated 5 candles, 20 hours, or 82 pips earlier than the normal MACD. And again, a buy signal this time indicated 4 candles, 16 hours, 148 pips earlier than the normal MACD. And the last comparison, this time a buy signal indicated 6 candles, 24 hours, or 98 pips earlier than the normal MACD. So that is why for this strategy, we will be using the TSRI MACD. And to increase the probability of a winning trade, we're not going to buy or sell just because the MACD crosses. Instead, we're using it together with the trend and key levels like the support and resistance. Check out the links below on how you can get the TSRI MACD with no money down. Let's start with identifying a buy signal. The first step is that you want to look at how price was previously moving. Was it moving higher? Then you want to identify the key levels that price was reacting to, the support or the resistance levels. The next step is you want to use the MACD to indicate that the start of the momentum towards upside by waiting for the MACD line to cross above the signal line. If all the rules are met, you take a buy position. On the other hand, when we look to find a sell signal, again, the first step is that you want to look at how price was previously moving. Was it moving lower? Then you want to identify the key levels that price was reacting to, the support or the resistance levels. The next step is that you want to use the MACD to indicate the start of the downward momentum by waiting for the MACD line to cross below the signal line. If all the rules again are met, you take a sell position. After looking at the buy or sell signals, you want to consider your exit strategy. If you took a buying position, you want to place your stop loss below the previous candle low and set your profit target at 2 times your stop loss. Similarly, if you took a sell position, you want to place your stop loss above the previous candle high and then set your profit level 2 times your stop loss. I'm going to now prove that this strategy actually works by backtesting it 100 times. I will be backtesting this on the H4, the H1, and the M15 timeframes and across different currency pairs. By the way, if you want to view the details of every trade on this backtest, you can check it out in the links in the description below. And finally, after backtesting the strategy 100 times, the results are in. Out of the 100 trades, we received a very good win rate of over 80%. And in total, we made a profit of 4,010 pips between the 7 month period of February to August 2024. I've just reviewed to you a very simple, high win rate strategy that you can use immediately right now. And all I ask in return is for you to invest 2 seconds of your time into liking the video and subscribing to the channel.